Good morning. Well, it's 10 o'clock. We'll get started here on the Oklahoma City Post-Employment Benefits Trust here for August 14th, 2023. So I'll call the meeting to order. Item number 2 on our agenda is approval of minutes. Have a motion and a second. Record your votes. Item is approved. Item number 3, items for consideration. Item 3A is receive the quarterly investment report for the period ended June 30, 2023. We have Doug Anderson here to present.
Good morning, Mr. Chairman and trustees. We have good news today. I think I can use this. Okay.
Finally.
Finally. There's only 3 really bad quarters in a row. Market actually bottomed, U.S. equity market bottomed in, I'll say, October of last year. And it's been really nice since then, actually. This page, on page 3, you can see quarterly performance summary of domestic equity, international equity, and then bond markets. And one thing that you see here during the quarter was a great quarter, right? 8.7% for the S&P 500. But you do notice that there's a drop-off when we go down to Russell Mid-Cap and Russell 2000, which are small-cap companies. And during the first half of this year, we saw another change in market leadership. Last year was energy, right? Energy was up 60%. The rest of the market was down. This year, with the advent of ChatGPT and OpenAI and all of the other AI issues that are going on out there, market has turned back to technology leading the way. NVIDIA is a $1 trillion company all of the sudden because they make the chips that make AI processes run better, faster, and more efficiently. So we've had great returns on the U.S. equity market, but led again by the S&P 500 and the biggest companies in the S&P 500. Look at international equity. Returns are weighted towards developed markets, and that's another way of saying that China is lagging. China's recovery, reopening has been disappointing, to say the least, and you see that during the recent quarter, the second quarter of this year, EFA, that's so-called developed markets, Europe, Asia, Australasia, and Far East, was up 3%, but emerging markets are only at 0.9%, and emerging markets is dominated by China. Looking at the trailing 1 year, finally, here we see double-digit returns. Last year was the worst year for a balanced fund investor, so somebody invests in stocks and bonds at the same time. This year, you can see why we do hang on. Bonds are still not doing great, but equities have come around. And the narrative in the market last year was we're going to have a recession, but it's not as bad as we thought it was going to be. This year, the last few weeks, it has emerged, it has changed, the narrative changed to we're in a soft landing. That the Federal Reserve might be able to thread the needle of reducing inflation without impacting employment. Now, I will say one thing. The Federal Reserve has been extremely active over the last year. Interest rates have gone from 0, Fed funds rate has gone from 0 to 5.25%. How that translates to us every day is mortgages, car payments, variable rate, debt of any type has gone up pretty dramatically. What has not gone up has been unemployment. Unemployment is lower today than when the Federal Reserve started raising rates, if you believe the figures that are published. And we don't know that these are always true. We don't know if inflation is always as high as it was last year. It's definitely trailed off. But the balance the Federal Reserve is trying to strike is low inflation and low unemployment. And right now, unemployment has not changed. Inflation has come down. So we may have, or the Federal Reserve may have threaded the needle on this one. That's unusual. Next page here shows you the performance of the various parts of the domestic equity market. The theme here is that growth is outperformed again, and that is why we have both growth and value in the portfolio. When we go to the largest companies in the index, I want to take a moment on this. The Russell 1000, this is the 1,000 largest companies selected by Russell to represent the U.S. equity market. If you look up on the upper left-hand side, Apple is 7% of that index. Out of 1,000 companies, Apple is 7%. Microsoft is 6.2%. If you were to build a mutual fund and market it to investors with this type of weighting scheme, you would have to call it a non-diversified investment vehicle. So there's something a little bit odd about the fact that these mega cap companies are doing so well, but I really don't know what the solution is. And if you look at performance for Apple, they're up 43% over the last year. So again, while it didn't do great last year, it certainly has done fantastically well this year. Going on to international equities, we don't have a ton here. We have some, but the story here is that one-year performance has gotten much better. Latin America has been very strong. Asia, emerging markets have not been strong, and that's again because China has lagged after their reopening, their delayed reopening, I would say. And if we look at this, the largest, just to give us an idea of what the benchmark looks like, Japan is 22.4%, UK is 14.7%. And then we go France, Switzerland, and Germany, which Germany is decreasing in its weight as one of the third largest exporting country in the world. And they've actually had 3 negative quarters of growth in a row. And then looking at the rest of the developed and emerging markets countries here, you do not see countries going from the emerging index to the developed index. It's just never happened. It probably should, but it never has. We do see companies go from the emerging to the frontier as they falter. Argentina is probably the case most commonly seen there. And then fixed income. It's been a strange year for fixed income. It has been a year of inverted yield curves, meaning short-term interest rates are higher than long-term, which is a market distortion and generally comes before a recession. But it's also been a year where the more risk that you have taken, the better your returns have been. And if we look on this chart, for the one-year performance here, U.S. Treasuries are down 2% over the last year, but U.S. high yield, we call those junk bonds, is up 9.1%. And that generally happens when you see economies in recession or coming out of recession. And normally that's not to be the case. One thing I will say about fixed income is that fixed income now has yield. And if we look at the yield curves on the bottom right-hand side here, the Treasury yield curve, the yellow is the most recent yield curve. So what this shows you are what the interest rates are of Treasury bonds going out for the following maturity years here, or periods. The 1-month Treasury bill has a yield of about 5.25. You go out to the 1 year, it's a little bit higher than that, but you go out beyond that, you're getting paid less interest for holding bonds of longer maturity. And that is a distortion, and it's not one that we see too terribly often, but it does often come before recession. I've heard it say that an inverted yield curve has predicted 11 out of the last 7 recessions, so it's not always foolproof. Sometimes it is a false indicator, and this time might be one of those. But the yield curve has been inverted for over a year. This is also telling us that we can hold cash and make decent returns now, 5%. If inflation is less than 5%, you're actually being paid to keep money in cash, which is not something that we've seen since 2001. It's been 22 years since we've had short-term interest rates this high. Here's the total fund rate of return on page 12, 13.4% for our for the year ended June 30. This is fantastic. When I look at the return here, I'm going to go back to the finally comment that I heard earlier. You can see that we had 3 down quarters in a row on this slide. That's not very common. Over the entire history, we've not seen that very often, 1 or 2, but last year we saw 3, and that was because of inflation and because of the global, I would say, geopolitical events that were going on last year. You can see here over this entire period of time, income has produced 195% of the initial outlay. That's fantastic. You can see that the initial market value is $6 million. Contributions have been very strong at 151. We have pulled out $105 million. We have had gains of $43 million, and we have the ending market value of 95. The return over this period of time is 167%. And remember that in the early days, we took a very risk-averse strategy because starting a new portfolio in 2009 was a pretty uncomfortable situation to be in, almost like starting one last year, almost the same. And you see here that asset allocation's been fairly stable over time. And here, our domestic equity allocation is 64%, core fixed income at 15%, international equity at 12%. So if I were to classify you amongst other public funds like yourselves, you have more equity. You have a long-term time horizon, and I think that's appropriate to have more equity than other folks out there who have a shorter time horizon. Your largest fund here on page 17 is the Fidelity 500 Index Fund, which is extremely low cost, followed up by Causeway International Value Equity, and then Stevens Small Cap. I will say that during the quarter, we had almost no cash flows. And I would say that going forward, we're going to be paying very careful attention to asset allocation. Equities have been fantastic this year, but we all know that that's cyclical and won't go on forever. The question is, do we take it out of equity and recycle it into bonds, or can we put it in cash for near-term or for near-term cash needs? And that's something that I see a lot of people doing. Some clients of mine who have very known cash needs generally keep about a year's worth of cash on hand. Today, they've moved out to 2 years. And I think that's fully appropriate given the distortion that we're seeing in the yield curve. So when we look at returns here, total fund at the very top, total fund market value at $95 million. For the quarter, you're up 4.6%, and that ranked in the 5th percentile of your peer universe, which is all public plans. Knock on wood, we'll be having to reclassify you in a larger size because this goes from 50 to $100 million of market value. So you'll be moving up to another larger one in the near future. And we do that mostly to take out the effective fees because that's the biggest factor. We can't say that just because you're bigger, you're going to perform better. We can't say because you're bigger, you're going to be paying less on management fees. So that quarter is a great result. You can see for the year to date, 11.29 for the first half of the year, 2nd percentile. That means you outperform 97% of other public funds in your peer universe. For the last 1 year, 13.44, again, fantastic relative and absolute results. A year ago, probably wouldn't be saying we're going to be up 13% over the next year, but this is why we stay diversified. You look at the 3, the 5, and the 7-year results. Those are annualized rates of return. And again, those are fantastic results, both in relative and in absolute terms. When we go down the list, fixed income was the toughest spot to be in last year. And the most difficult portfolio last year, of course, is going to be the long duration manager, Hoisington down 10%. But as we go to nearer term, year to date, you can see that our returns have turned about or have turned positive for the year to date period. For the domestic equity portfolio for the 1 year, the S&P 500 was the best performer. You can see that our mid-cap index is performing exactly where it should. Hotchkiss & Wiley was probably holds the record for being on the watch list for the longest of any of the funds that we've had, and has done fantastically well. When you compound that 3-year rate of return, that 29.62%, which ranked in the top percentile of its peer universe, so a return of 29%, 29%, and 29% 3 years in a row, it's about 130% return from this portfolio over the last 3 years. And it took some patience. But if we're going to be taking money from equities, it's probably going to be coming from them because they perform so well. And then our small cap manager, you can see it here, has done okay, but they're pretty cautious, so they're not investing in the highest, most speculative companies out there. And our international equity portfolio managed by Causeway has had an incredible resurgence also. So,
hey, Doug, can you go back to
of course.
Hoisington on the fixed?
Yes.
So looking at their performance, they've underperformed 1 year, 3 year, 5 year,
Yes.
7 year. So are they on a watch list?
They are on
Okay.
the watch list, absolutely. And remember, this is a very unique portfolio. It does a couple of things. for us. It gives us exposure to the long end of the Treasury curve right now. There's no credit risk in this whatsoever. Well, since Treasury debt was downgraded a couple of weeks ago, I guess that's not entirely true. And they give us some diversification from equity market vol, except for last year. And last year was the first time that we've seen inflation since the early 1980s. And Hoisington still thinks that we are probably headed towards a recession. They're about the only manager that you have that is positioning the portfolio that way. So yes, last year was an awful year for them. I would say that their better benchmark is the long-term Treasury, but still, they still underperformed that. It's a simple portfolio. Every other situation where we've seen equities go down dramatically, they've gone the opposite direction. So yes, to answer your question, in a wide arc there, they are on the watch list, and they should remain there. So that is performance. Performance has been fantastic. If we look here, the decisions, the managers that we've selected, and the rebalancing that we have done over time has both added value to the portfolio. I'm going to go briefly to, I think this is we don't go over these very often on this slide. So this is a cumulative return chart for your fixed income portfolios here, and it's just the fixed income. The blue and the yellow are sort of your mainstream portfolios. Those are your core portfolios. So that is Loomis, Sales, and Double Line. Red is your high yield bond portfolio, which since 2018 has outperformed. And then Wasatch is Hoisington, right? You can see 2019, we had the thing called the taper tantrum when the Federal Reserve said we're not going to be printing free money forever. We're going to start pulling some of that back in. And that affected the bond market, and that affected the equity market. And the only portfolio that you had at that time that did well over that short period of time, and then at the beginning of COVID, was Hoisington. Everything else went down, and went down dramatically. If we can see this area right here, that is the period that Hoisington went up, and that's their normal performance pattern, which is why they're a part of the portfolio. I think another thing, it's a measurable, it's a fairly small part of the portfolio. It's 6% right now. And despite what the allocation would suggest, we're not going to force any more funds into that portfolio right now. It's just not necessary. For the long term, I like it. For the short term, I think cash is an alternative right now. Cash is an alternative for lots of reasons right now, but it's one that we have not seen for quite some time. So if we need to pull cash, or if we need to rebalance the portfolio, which are kind of close on the equity side.
So how do you balance out the fact that you need to rebalance, you need to harvest your earnings, but you can sit there and put the money in a money market and make 4 or 5%. But as we've always been taught by people like you, is you don't try to time the market.
Right.
You stick to the fundamentals. You put the money in. By doing that, there's an opportunity cost probably to us long term by keeping it in there at 4, where if we had it in there, we could have set it, bought it at lower, or you buy it higher.
Right.
Then that impacts your overall returns long term. So how do you balance that out?
Well, I think the one extenuating circumstance we have right now is the inverted yield curve, right? I think that cash is part of the fixed income market, and today it's the most attractive part of the fixed income market. And I don't think that we're so much timing the market, because over time, the yield curve will revert to normal, and we don't know exactly how that's going to happen. If we go into a recession, the entire yield curve will go down, right? Yields will go down. And so holding longer duration debt will be advantageous to you. But I think on this page, so 49, you can see that we're overweighted domestic equity. We're getting pretty close to the maximum. And when we go above the maximum, we'll need to rebalance. And when we do that, we're dollar cost averaging, right? We're taking away from our best earners, and we're going to give it to something that's undervalued. And at this point, am I more comfortable owning a 30-year treasury or a money market fund? Money market fund, absolutely. And I don't think it's market timing. I just think that we're taking a broader view of what fixed income is, and that includes cash. So that is our asset allocation. Here are the very long-term rates of return. I need to go back to, there we are. Trustee Barry, we are still on alert here, like you said. And we only have one manager on alert, which is fairly unusual. And then on this slide is our fees. So the management fees that are paid to the mutual funds that were invested into weighted average basis of 43 basis points. The category average, you can see next to that, and the weighted average category is 91 basis points, so we're less than 50% of the average fee for a portfolio allocated like this. A big part of that will come from Fidelity. You can see that it's 1 basis point. It's actually a little bit less than 1 basis point per year. And the average in large cap core is 88. So we're definitely allocated to places that we think we can add value. And every investment that's listed on here has a very distinct place in the portfolio. I'm happy to take any questions. Of course.
Is there a report that shows which companies we're invested in? Do we have that, or can we get that?
Yes, absolutely.
Okay.
Is there a topic that you're...
No, I would just like to see which companies we're invested in and the
So,
weight.
underlying equity portfolios?
Yes.
Yes, okay. Yes, we can get that.
Thank you.
All right, any other questions? Seeing none, I'd like to consider a motion. Record your vote. Passes unanimously. Now, item 3B is to receive the monthly investment reports for May 31st, June 30, and July 31st. And I assume you're just going to go over the July 31st. Doug?
Perfect. This one will be even shorter. When we go through the end of July, markets were positive in July also. And again, you can see how strong performance has been on that chart on the upper right-hand side. That is a year-to-date, day-to-day return of all of these indexes that we show. Russell 1000 is still the leader. Russell 2000 and international equities are actually almost tied so far for the year-to-date. But if you see year-to-date returns through July 31st, 20.69%. I mean, that's fantastic 7-month rate of return. And remember that returns tend to be lumped together pretty closely, right? You have really poor returns that come in a bunch, and then you have really great returns that come in a bunch. But if you look at this year, we've had one negative month, and the rest have been positive for the Russell 1000. And then looking down to equity sector, month-to-date, year-to-date, we are positive on all sectors except for year-to-date. Utilities are down slightly. And that's a reversal from last year. Energy is actually up, but most of the returns are coming in information technology. Like I said, AI has reinvigorated that marketplace to an astonishing degree. $98 million here, so we're again getting closer and closer to the $100 million mark. For the month, 286. For the year to date, we're up 14.47 for the total fund. Trailing one-year return, 9.16. And if you will remember back, that number has come down over 1 month. Last year and this year, we've had some pretty volatile months. And so when we move forward 1 month, we added on at 2.86, but we took off, I think, a 6% return at the very end. And so you're seeing these really dramatic switches in the trailing one-year return. I had a client ask me to recalculate a rate of return because the May 31 return, trailing year for their portfolio, was down 70 basis points for May, so ending May 31. But the June 30 result was positive 14%, and they could not see how that was possible. So you're not alone in seeing these returns change pretty dramatically. And again, last year was pretty volatile, and this year has been too. Not a lot of changes in relative returns here. Good strength in the equity portfolios. International equity has done fantastic. Year to date, they're your highest performer, and for the trailing 1 year, which I don't remember the last time we could say that international equity is outperforming. When we look at the fixed income portfolio, trailing year is still down. And again, you can see that the returns are pretty volatile, again, throughout that portfolio. The part of the portfolio that's supposed to stabilize us has not really done so because we've been in an inflationary environment. And you can see that cash holdings are fairly minimal there, but that's yielding better than 5% today, which again, you have to go back to the early 2000s, like 01, to see that kind of result. And I'm happy to take any questions.
Questions for Doug?
I don't have it.
Shocking.
We'll consider a motion then. All right, there we go. Motion and seconds. Record your vote. Item passes unanimously. Thank you, Doug.
Thank you, Mr. Chairman and trustees.
Item 3C is renewal of agreement with Nyhart for actuarial services, estimated cost of $21,000, retroactive to July 1, 2023. This is the second of 5 renewals, so I'll entertain a motion on this item. Item passes unanimously. Item 3D is ratifying claims from May 3rd, 2023 to August 1, 2023. Any questions, discussion? Have a motion and a second. Item passes unanimously. Item number 4, comments from trustees. Comments from staff? Or any other interested parties? All right. Then item number 5, seeing we're at the conclusion, item number 5, we are adjourned.